everyone. My name is Lucy Morales, and I am part of the Education Committee. We are here today to have our part 2 of the tax strategies. We have our accountant here, Jeff. Thank you all for being here. If you can please silence your phones, and if you need to take a phone call, please go out to the hallway. Mr. Huang is a seasoned certified public accountant with over 20 years experience of public accounting, including experience in Arthur Andersen, one of the big accounting firms, and senior management experience as a CFO and controller, as well as private accounting experience in one of the Fortune 500 firms. He specializes in small and medium-sized business management and tax planning, real estate taxation and planning, foreign nationals taxation, IRS audit representation, startup business accounting, financial reporting, and management consulting. In addition to CPA and MBA, Jeff is also a certified QuickBooks Pro Advisor, Microsoft Certified Professionals, and Microsoft Certified Database Administrator. Jeff likes to play tennis, read books, and volunteer for the community services. Let's give a warm welcome to Jeff Huang.
Thank you, Lucia. First of all, thank you so much for the invitation from West San Gabriel Realtor Association. And thank you for Education Committee for all the arrangement. First of all, I would like to introduce myself. I'm so proud of the member of West San Gabriel Realtor. So I have been the member for 22 years already. So you won't see me very active in the real estate community because my focus, I know that I'm the CPA, my focus should be on tax, on accounting side. But I'm being there. I know as a realtor professional how we've been through. So today we go over the part 2 for 2025 tax planning for realtors. So before we start the presentation, I will ask the questions. How many of you live in County of Los Angeles? Oh, wow. So almost 90% we live in County of Los Angeles. So let me ask the second questions. When will be the deadline for personal tax preparation? When? Okay, I answer April 15 and October 15. Both answer is correct. It depends on. So if you live in the County of Los Angeles, the deadline will be extended to October 15, automatic. So if you're not living in County of Los Angeles, and the deadline is April 15, unless you file the extension to extend the due date. And let's go over today's my agenda here. So his agenda, we go over like continuing last time. So I would like to be today's presentation more interactive. So stop me if any questions. I will try my best to answer the questions. So his agenda, we go over 2025 tax law update. And also we need to maximize the deduction for realtors. The most important things we need to try to avoid in the future IS audit. So I will bring up IS audit reference and also for realtors. And most of us maybe right now we're helping the foreigner selling the property in our communities. So I would like to draw attention some of the the tax issue for foreigners selling the properties. And also there's some non-resident have the title transfer. And the last things we talk about the estimate tax payment and also avoid the penalty. And the last things we have the Q&A. So here's my agenda for today. So before I start the agenda, so let me ask these questions. How many of you, when we file tax return, what we need to do, just sign? Do you know why you sign? What is the purpose for you to file the tax preparations? Have you thought about that? Yeah, so let me give my experience on the tax preparation side. Tax preparation is not only the data entry. It's not only you sign the form. You should reflect your financial goal. So for example, in my age, I'm thinking about the retirement side. So how we use the tax to help me to be minimize my tax and make my retirement planning easier. And also the other things, as a realtor, we have a lot of chance to find a lot of good deal on the market. So then really the question for us, do we really minimize the tax? Because sometimes I would tell my clients, paying some tax is not the bad thing, because it depends on what would you like to achieve. For example, we find a good deal on the market, and instead of selling the property, and we might use this as our investment property. At that time, we need to get a loan from the bank. So if in that case, they look into your income, and do we have enough income to qualify for the conventional mortgage? So at that time, we need to be have the income to support for that. So that's one question on that. So that's another thing. If we over 60, I will tell you the good news. If between 60 to 63, and that have a super size retirement catch up for today on that. So let's start the meeting. So as a realtor, and that's a common we face. First one, our income is not like W-2. For W-2, we have the fixed income every month. And the realtor, sometimes we have big commission coming up, and sometimes we don't have commission for a few months. So our income frustrations. And the other things, as a realtor, we have a lot of expense. So for example, we have the mileage, auto, and sometimes we might have to have the meal with the clients when we show the house. And also sometimes we have to give the gift to the clients. So those on the deductions, when come down to audit, how we document those deductions. And the other things, as a realtor, and the most tax we have to pay is the self-employment tax, which 15.3. So that's the common tax charge for the realtor side. So let's take a look on why it's important for the realtor for the tax planning. First one, we need to be tax compliance. So we want to make sure that we have the peace of mind, and when come down to audit. So that's in compliance, and which I can share with you some of the common things draw the reference. And also we need to have the financial optimization. And also we need to have the future prepare for in the future, and also tax law change, and also the market change on that. Okay, so very quick update. If you live in Los Angeles counties, because the wildfire, they automatically extend the fine deadline to October 15. So you can see that that's come from IS announcement, IR 2025-10. So what that means to us, so first one, the income tax return and payment normally due on April 15, and right now it's automatic extend to October 15 if we live in County of Los Angeles. And also the good news for the IRA contributions, and normally due date is April 15. If you live in County of Los Angeles, and the due date will extend to October 15. So that we have more time to make the IRA contributions. And also for the estimated tax payment, so if you haven't made the Q4 2024 estimated tax payment, which due by January 15, 2025, in this case, if you live in County of Los Angeles, it's automatic extend to October 15, 2025. Yeah. And also the other things, if you have any client, they go through the unfortunate the disaster loss, so they can claim the loss in 2025 or 2024 tax return in those 2 years tax return. So so the election must be claimed made by October 15, 2026, and they can use the form 454A56-DR. So, and also the one thing I would like to draw attention, because the fire, and people had to pull out the money from their retirement account to rebuild the house. And normally, if you are younger than 59.5, they have the 10% penalty for early withdrawal. Because the fire disaster, and you can waive those 10% on that. Okay. So next step, the other update I would like to share with you, if we take a look at the news, in 2025, and IRS recently laid off 6,700 people. What that means to us? Yeah. So let's take a look at the bad news and also the good news. So the bad news and the support from IS had less people support. So means that if you dial the phone number 1-800-1040, and you had to wait long time be on the phone call. So we have the less support. And also, if you submit the tax return via paper, via mail, and it takes time to process. So it will less take more time for you to get the refund. So that's the bad news. So let's take a look at good news. Because IS have less people, the field audit chance is less than before. The people go to the field audit. So lately, I do see that the audit is less than before. But the one thing I would like to draw attention, because all the AI, and as use the data, use the computer system, doing all the computer audit. So you might be seeing more isolate come out because they use the data on that. So that's the things. So that's for us the approach is, first one, we understand what's the data as a realtor, what kind of common expense we have, and what's normal standard ratio, not draw attention before we can go through the computer side. So that's which I will cover later on that. So the other things I would like to share with you for IS, they have the system correct all the data. So for example, it's called income, wage, and income transcript. So right now, for example, we have 1099 and people give you 1099. And you're thinking, oh, I don't receive 1099. They get lost in the mail. Should I need to report on the income side? Yes, yes. So even though you get lost in the mail, that's in the I system. They have all the I system. They have all the 1099 report by someone. They store in the system, your database under your social security number. Yeah. So that's one thing when we file tax return side, we need to make sure that our income report is more than the 1099 NEC we receive. So for example, in the I system, we have 80,000 on the 1099 NEC. So when you report, when you file the Schedule C, you only report 50,000. What that mean? Yeah. So you're welcome to us come to see you. Because 50,000 report, 80,000 in the system. So I just want to see why you underreport the income. Yeah, so that's things I would like to draw attention. That's also the good news and bad news on that. Yeah. So let's take a look 2025 tax update. So I have 2024 and 2025 the comparison. So for the standard deduction, like if you're single, 2024 is 14,600, and 2025 is 15,000. So if you marry fine jointly, they increase about $800, and in 25 is 30,000. So you can see that's the standard deduction. And the next one, I would like to draw attention that like in the tax bracket, they have 7 tax bracket. That's very important for us. We can do the tax planning before the year end to see which tax bracket you would like to be in. So if you take a look at the 7 tax bracket, so we start with 10%, 12%, 22, 24, 32, 35, and 37. I'm going to stop right here. Do you see that on those 7 tax brackets here? Is there any big jump in between? 10, 12, 2%. 12 to 22, 10%. 24, 32, 8%. So, I mean, you can see that those 2 tier is a big jump. So when you come down to your income side, you can ask yourself, am I go to 24 to 32? What can I do differently to lower down this big jump, which I can share with you later on. That's some of the technique we're using. Yeah, so here's the marathon journey. The same thing, we have 7 tier. So we have you start from 10, 12, 22, 24, the same tier as the single side. Yeah. So the one thing I would like to draw attention, if we had a good year, we make a lot of commission, and our income over 731,200. So we are on the 37% tax bracket. What that means to us, the good things, you're making more income, so you pay tax. The other things on this tax bracket, if you have any long-term capital gain, normal long-term capital gain over 1 year is 15%. If you're on the 37 tax bracket, you are on 20% on the capital gain. So you have to pay 5% extra. So that's I really like to draw attention. When we're making a good year on the 37%, we try to avoid, maybe it's possible we can shift a little bit on the long-term capital gain because we don't want to pay the extra 5% on that. This is very important for us. As the realtor, we're always helping people. And some of the questions I told my clients, you need to take care of yourself because we are the one who needs to take care of ourselves. So by taking care of yourself, first one, we're making income. That's your hard-earned money. So why we give to Uncle Sam and pay tax? And the one thing I would like to share with you, that is a legal way. We put away on the retirement side. So let's take a look at the retirement side. So we have different kind of retirement. So we have the IRA, we have 401k, we have catch up, and also we have the profit sharing. So at the self-employed realtor, so we can do the contribution up to 25% of our net profit. So I would like to draw attention at the bottom here. 401k, like the total 401k and also the profit sharing. The total in 2024 is 69,000. In 2025 is 70,000. So the other things I would like to draw attention is the regular 401k. So it's 23,000 for people under 50 years old. So they have to catch up. If you're over 50 years old, 7,500. Here is really important, the new change. And that's a special bonus for the people at the age between 60 to 73. So we have the additional, it's called super size catch-up contribution for the 401k. So this means that for retirement 401k, 403b, and also 457 plan, we have the extra 11,250. So that means that the maximum we can put away is 34,750 if you're on the age 60 to 63. And also for the simple IRA, we can extra contribution 5,250. So the total 21,750. Okay, so here is the like traditional IRA contribution and the Roth IRA contribution. So besides 401k, and we would like to make additional contribution on our retirement. So we can look into like the traditional IRA and Roth IRA. Yeah, question, yeah. The question is for the age, how we calculate the age. So it's December 31st, 2024. Yeah, so that's the age on that. Yeah. So that's we can take a look at if you can see that at the traditional IRA and Roth IRA, if you have any like the retirement, so there's a limit income limit on that. And in general, Roth IRA, the limit, income limit is higher than the traditional IRA limit. So, for example, we're married and also we have the 401k. So you can take a look at like in 2025, the income phase out is 126,000 to 146,000 on the traditional IRA. And if we take a look on the right column side, the Roth IRA, the income limitation is 236,000 to 246,000, which is about 110,000 more income. So the question comes down to here, if you don't qualify for the transitional IRA becomes the income limit, maybe you can consider the Roth. And the next one, before I go to the QBI deduction, the one thing I would like to draw attention for our realtor, if your age is over 59.5, and maybe at that time we need to consider do the IRA conversion. Let me explain to you the concept for IRA contribution. So IRA have two kinds. One is traditional IRA, benefit now and pay tax later. That is the traditional IRA or SEP IRA. And the second IRA type of IRA is Roth IRA, benefit later, and you pay tax. That's the tax you pay tax after tax on that. So that means that the second type, when we retire and we withdraw the IRA for Roth IRA, and we don't need to pay tax for the Roth IRA. So that's something I would like to draw attention. If you consider retire on the year, your income is not high as before, we might need to consider the IRA conversion. So because we always thinking when retire, we don't want to pay any tax on that. So there's something strategies for you. So, and also keep those in mind when I share with you the 7 tax bracket, and you take a look your income, if you follow any additional room for you to do the conversion on the IRA. So let me go back to the like the screen here. That's 2 ways. First one, to clarify the question, I repeat the question to make sure people online can hear. So the question is to qualify the traditional IRA or Roth IRA, is the past income can qualify? Is this a question? Yeah. So let me answer the question. It depends on. First one, if you have the earned income, you can deduct up to your earned income. So I give examples. I mean, for the people, for example, age 50, so we can qualify up to 8,000 on the transitional IRA and Roth IRA. So in that year, we don't have any earned income. We only have the passive income. So the passive income may be a capital gain or maybe like the rental passive income. So in that case, we don't qualify for the IRA contribution because we don't have the earned income. But in some case, if you marry jointly, and if the husband working, the wife is not working, and you still can qualify because the husband have the earned income for the family. If in that case, it's married jointly. Yeah. So if you marry separate, that's a different situation. If married separate, the income limit is much lower, which is $10,000. Let me repeat the question for the people online. So when we do the IRA contribution conversion, I'm sorry. So that means that we take out the traditional IRA and put into Roth IRA. Is this considered income for the year? Yes, the answer is yes. So if we take out the money, convert to the Roth IRA, that portion is the income. So that's very important for us. Take a look at the tax bracket here. Take a look what income tax bracket you are in. So in that case, we may find jointly. So I threw out the examples like we have the income like 201,000, maybe 150,000 for Marathon jointly. So we follow in the 24% tax bracket. So that means that I have 50,000 more before I hit into the next bracket, which 32, which I'll try to avoid. So that means that if you want to do the conversion, I mean, I recommend go with less than 50,000 in this scenario. Yeah. So, so a very good questions. That's very, very important because I do see that when we approach the retirement stage, and when we don't want to pay income tax when we withdraw the IRA, and also is anyone know the RMD, requirement minimum distribution? So that means that when the age 73, you require withdraw the money within the IRA, sub-IRA, any before tax account, that's RMD. So by this approach, we can try to be like convert to the Roth conversion. So I do see that a lot of the people at the age around 60, and we still look into the conversion on that. So one thing I would like to draw attention, and one time I have a client come to my office, and he had 200,000 on the IRA side. He do one-time conversion. He take the money out, convert to the Roth IRA. So I told them, no, that's not good, because all of a sudden you add on 200,000 on top of your income, and that move up your tax bracket. So I don't recommend that. And when you do the conversion, and we need to sit down, take a look which bracket, tax bracket you are in, and which tax bracket you try to be in when you had additional IRA. Yeah, that really, this the tax bracket really helping you decide the next step. And also the other things I would like to share with you as a realtor. And when we had a good year, and so we had to pay a lot of tax. So the things we need to consider is using the retirement to shelter the income, especially when people around 59.5, and you put more on the sub-IRA or retirement side, and then you lower down the tax bracket for the year. And since you're 59.5, and next year we take out the money, there's no 10% penalty. So only paying back the tax on a lower tax bracket. So that's the one of the technique we're using, just like when you have a good year, how to be smooth things out. Yeah, so the other things are for the QPI. So, I mean, you know that we had 20% the qualified basic income deduction for most of the realtors. So that means that we have the net profit, and we can qualify 20% the deduction. But I would like to draw attention. It's not of us qualified 20% QBI deduction. If your income is high, you might be phased out for the 20% deduction. So let me share with you on that. So I mean, so what the QBI? QBI means that it allow the self-employed individual like us, we can deduct 20% of the net business income. So it applies to sole proprietorship, LC, S Corp, but not W2 employee. So if you're a W2 employee, you don't qualify the 20% QBI. So the deduction is based on the net profit after tax, after expense, and before the self-employment tax. So let's take a look at examples. Lisa is a realtor. She earned 100,000. I mean that net profit. So after the gross, after expense, the net profit is 100,000. So she qualified the QBI deduction, which 20%. So in this case, her taxable income reduced to 80,000. So that's different on tax savings side. Question. So my question is, we had a scenario, we had W2 income and also have the self-employed income. So the QPI only apply to the self-employed income in this case. Yeah. So if you have S corp, if LC, you have pass through, you might still can qualify 20%. So, but W2 not qualify 20% deduction. And let's take a look at the income phase out. So as I mentioned that the 20% QBI deduction is not applicable to everyone. They have the income phase out limits. For example, if you're single, if you're below the taxable income, 191,950, you can qualify 20% deduction. But if you over 241,951, sorry, your income is too high. You phase out on the 20% deduction. And the same thing for married, if jointly together, if your income over 483,900, and the 20% deduction is phased out. So that's very, very important. So one thing I would like to draw attention, that's a taxable income. So between the gross, the net, the taxable income. So there are few planning technique we're using and try to, if you have 483,000 as a married couple, you lose 20% deduction. There are a lot of that. So we need to figure out how can we reduce our taxable income below and then to qualify 20% deduction. So I would like to give you two concepts. One is the tax preparation. The other concept is tax planning. So tax preparation is after facts. So everything's happened after December 31st. We might not have too much things we can plan ahead. So in that case, on the tax preparation side, in my opinion, is in compliance stage. So we need to follow the IRS section code, make sure that we don't draw attention for IRS. But tax planning is plan ahead before the year end. So before the year end, so maybe you can see that your income is high and you will try to reduce your taxable income. So we need to plan ahead. So we take the action item and then that way we can do things in the legal way. So for example, you can plan ahead, maybe you can set up your retirement, like set up the sub-IRA, or one of things is called pension, it's called DB. So if we are the realtor and we can qualify for the pension, which is higher more deduction. So it's over 100, 200,000 deduction. So the based on your age, based on your income. So we are not the one who give you the number. That's the actual, and based on your income, based on your age, they give you the number on that. So I do see that a lot of the like the medical professional, and they will take advantage on the pension. It's called defined benefit plan on that. But this one had to be implemented before the year end. So the other things for the realtor, we have the self-employment tax. So as I mentioned that it's 15.3%. We have Social Security 12.4% and also 2.9% on the Medicare. And also one thing I would like to draw attention, for the high earner, we have additional 0.9% on the Medicare tax. So that means that if our income over 200,000 for single, and if we have marriage jointly, 250,000, and we might have to pay the additional 0.9%. So one of the possible solution, we might need the considerations. We might consider set the S corp to lower down the self-employment tax. So for S corp, the beauty, so let's take a look at the comparison. Schedule C, all your net profit is subject to 15.3% self-employment tax. For S corp, only the portion, the compensation to the officer, that portion is subject to the employment tax. The net profit portion only subject to the income tax. So for S corp, one of the purpose for the S corp is to minimize the self-employment tax. But I would want to draw attention to one thing. For S corporation, because we minimize the self-employment tax, so that's in the situation we had to pay ourselves like reasonable amount salary. So for example, we making the net profit 300,000, and on the compensation to officer, we only pay 20,000. Is this reasonable? No. Yeah, I mean, I think this is good. So the reason why what is not reasonable, because if you take a look at like on the 1120S, I believe line 7 is compensation officer and the line 25 is net profit. So they will compare those two lines to see whether you pay yourself reasonable amount of salary. So one thing, if you have the S corporation, when you go home, we take a look the compensation officer and the net profit. So do we pay ourselves reasonable amount salary on that? So as I mentioned that us have the less people right now, but they will utilize the computer system to checking. And as I mentioned that we can switch the S corp to lower down the self-employment tax. So let's take a look at the example here. John is a realtor. He earned 150,000 as a sole proprietorship. In this case, he had to pay 22,950 on the self-employment tax. So if he switch and as an S corp, so he pay himself 60,000 and the other 70,000 as a net profit for the company. So that way he only paid 13,800 so for the self-employment tax. So in this case, he's saving about 9,000 on the self-employment tax side. And also, some of the strategy for us is on the tax planning side. So at the end of the year, you can take a look what your income looks like. Do we come to the income limit, phase out income limit? At that time, we might need to do the income, the timing, and also expense it to the planning side. So, for example, we expect we're going to get the 40,000 commission in December. So, I mean, in that case, is it possible we can delay the closing and closing in January? It's possible. I mean, that's something you need to plan ahead and talk to the seller side. So that way we still can comply and we can below the QBI phase out limits. Or maybe you can use the deduction or use the retirement and use other deduction to lower down your income tax bracket. Question. Let me repeat the questions. So we're closing in December, but our commission check is received in January. So the question is, do we count the commission in 24 or 2025? So the answer, it depends on. If your broker send you 1099, if they send you the 1099, even though you don't receive the check in 2025 December, they count you as the 1099. In that case, we have to report as the income. So in that case, you might need to work with your broker. With your broker, and it's possible they can, because this one really the check received in 2025, not in 2024. Can we have we had the 1099 issue for 2025, not in 2024? The question is the company give you out the bonus. Is the bonus subject to Social Security? That's the question. So first one is a company. So you work as a W-2 employee, as the employee. So bonus is part of the W-2. So that portion is subject to the Social Security and Medicare. And on top of that, normally the tax withholding for bonus is higher than the regular salary. The reason why in the system, for example, we receive 20% bonus for the month. And in the system, I mean, maybe you only receive 20,000 for the year. In the system, we consider 20,000 times 12. So when do the calculations, they expect you get 240,000 additional income. So that's most likely when we receive the bonus, the tax withholding is higher than the regular paycheck. But I mean, that's the withholding. That's your own money. So it's not like you pay out the IRS, just the prepay, the withholding. The other things I would like to share with you as a realtor, most of our expense is a home office expense. I mean, the home office, you don't need to have the dedicated room. So as long as the dedicated area should be okay. So this one, like if they audit, they don't want to see the personal item in your home office area. So for example, you don't need to have your packs item on the home office area. So, and also there's a regular use, so must be frequent use for business operations. Like when come to the audit, so you can take a look. The principal pays for the business is for manage the transaction, like client meetings and marketing, bookkeeping, and administration staff. So that's for qualified for the home office. So, and if you have two location, so we need to make sure that you use that other location regularly on that. And how to like this is the examples when come down the audit, and the auditor will ask us why we use home office for. So as a realtor, we have to manage the listing, and we have to call the client in our home office, and also we prepare the sales contract and negotiate the contract, and sometimes we need to do the marketing at home office. Yeah. And also we need to review the rental property financial, and also we handle the lease agreement, and also schedule on the maintenance. So that's what the realtor normally use for the home office. And for the home office, we have two methods. One is a simple method, which is $5 per square feet, up to 300 square feet. So that means that the maximum for the simple method, the deduction is 1,500. So what's the benefit for a simple method? So no need to check the home relay expenses. So you don't need to check the home mortgage, home property tax, insurance, and no depreciation. So when we sold the primary home, and if you use the primary home as a home office portion, you might have to be add back, and also that portion might not be qualified for the Section 121, which 250,000 capital gain if lived to out 5 years. So I give you examples. I mean, the realtor we use the attached garage as the home office. So which I will come down the next part first here. So that's which the actual method. I will come down here. So we use the detached office garage as our home office. So we had the deduction. So percentage home use for the business. For example, the home office about 300 square feet, and our house is 3,000 square feet. So that means that we can deduct 10% on the actual cost. So what is the actual cost? We have indirect expense and also indirect expensive. So direct expense, for example, we're painting the office, or maybe repair in the office expense. That's the direct expense. And I want to do the disclaimer here. Painting is the home office area. It doesn't mean that you paint the whole house 3,000 square feet and you still can qualify. No, only the home office area. And also we take a look at indirect expense, which including the mortgage interest and property tax and utility and homeowner insurance and depreciation and maintenance. So that is best for use the large home office or high home relay expenses. But the drawback for this approach, when you sold the house and the depreciation had to add back, and also the home office area might not be qualified for the Section 125, which capital gain over 23,000 per person if leave that to our 5 years. But there's the one catch on that. If the home office is attached your house, it's different from detach your house. If you attach your house, the home office might be able to qualify 250,000 exemption, but the depreciation had to add back. Yeah, so I think it comes down the stage, we can talk how do we plan ahead for that. So the other things for vehicle expense, I know that most of us we drive a lot, and that's the purpose for us. We're showing the property. So the question is for the home office, we have used the Wi-Fi. That's definitely we need to use the Wi-Fi. So do the Wi-Fi expense including in the home office deduction? Yeah. So my answer is the Wi-Fi deduction is the business expense you can deduct, but not deduct on the home office portion. So you can call out separate. It's called internet. Yes. So if we use the phone and internet, is the business deduction, but we had to take a portion for the business relay. So I have the one case a long time ago. So the people try to claim 100% phone expense as a deduction. And at that time, the audit will ask, give me the printout for the phone, at least one by one. Is this for the business side? Yeah. So and normally for the internet and phone, I won't recommend 100% unless you have dedicated area, unless they ask you, you can prove that's all for the business relate, and I will take the portion on the business side and portion on the personal side. And I will share the story. Like recently, I had the dinner with one of the auditor, and she shared with me the experience on the auditing side. So she told me one time she audited one of the doctor physicians, and she say she saw the meal side every day. That's the meal expensive. And she drove around the doctor. I want to be your patient because when it comes to you, and then you treat me the bill. Yeah. So that's things like we need to be reasonable. And I do tell my client side, we have to be business reason for all the business expense. Yeah. So for the vehicle, we have two options. One is a standard mileage deduction, which is the easier option, which is 70 cents per mile for 2025. And so this is best for the realtor. We use the high mileage and lower car expenses. So for example, we use Tesla EV car. So we don't have the gas. So maybe in that portion, we might use the mileage to get the deduction on that. Yeah. So examples, we drove 11,000 business mile. So we times 70 cents per mile, we can deduct 7,700 deduction. And the other option is we can use the actual. And this is most for the, we have the high cost vehicle. So we can deduct the actual cost based on the business usage. So that including the gas, oil change, repair, and maintenance, insurance, lease payment if lease, and also depreciation if we own. So the one thing I would like to draw attention, we had to deduct the actual cost based on the business usage. So it's not like we we spend like 2,000 on repair, we deduct right away. So we need to take a portion on the business on that. Yeah. So the other things are like for the travel, we can deduct the travel expense and 100% deductible. For the business meal, is 50% deductible. So let's take a look the reason for the business meal. Like we had client prospect meeting, and also we had business dinner while traveling, and also we go to the different real estate event or conference. We need to have meal, so that's meal can be deducted on that. Yeah. So yeah. So the other things like I would like to be draw attentions. We have we travel a lot, and for example, we travel to China for 3 weeks. So my question is, can we deduct all the? I mean, sometimes those 3 weeks we had the personal, we visit the family. So in that case, I don't recommend you deduct all the 3-week hotel. So for example, we have the trip to China to the like networking. So that portion, the airplane, and we can deduct the travel. The hotel, we're taking the networking, that portion can be deducted. And after networking, we be on our own. We visit our friend and family. That portion, I don't recommend we deduct on that portion on that. And also, I would like to like share with you the best practice. If as audit, we need to keep the receipt, and we had document who, what, when, where, and why, and also had the business purpose, and attend the meeting, conference, and property visit. That is the business purpose. And also, if you mix with business and personal, my recommendation is only deduct on the business portion on that. And let's take a look like the high audit risk area for realtor and how to avoid ICE red flag. So you take a look at those like the ICE red flag. We have excessive deduction like the vehicle, meal, travel, home office, and also we have the business expense not match the income. I can share with you. And also we have large charitable contribution without the documentation. And also we have unreported income or cash transactions. And the other things are overstay, real estate losses, and also high commission speed, and also unverified referral fees. So let's take a look how we prepare. Vehicle expenses. So we try to claim 100% business usage without any proof. So that might be draw attention because they will ask first things, you ask the mileage log. They ask mileage log. So the same thing, you have to, each log, you have to demonstrate that's for the business purpose. Because, unless you have to dedicate car only for the business usage. But most of us, maybe we have one car, sometimes in the weekend, we might go shopping, grocery shopping. So it's charged for 100% as a business deduction on that. The meals and the no entertainment meals deduct too many crime meals without the documentations. And also in the travel side, we write off the personal vacation as a business trip. And also the home office, we claim the home office is not exclusive for the business usage. So how to avoid those trigger? For the vehicle deduction, first one, we need to checking the business mileage. When I share with you, when we audit, the audit first question asks us, is to repair receipt. Why they ask for to repair receipt? Because in the repair receipt, they shows the odometer reading. So for example, in February 1st, we do the oil change. At that time, the meter reading is $10,000. In December, and we do another oil change, and the odometer reading is like 19,000. So that's true. They already know that how many miles you drive for the year. So in that case, 10,000, 19,000 is about 9,000. In that year, we came 20,000 on the mileage for the car. Is it reasonable? No, because they know February and December already 11 months, and 9,000. It's impossible you drive another 11,000 in 1 month. And also why they ask the business receipt, because when we do the mileage log, and they want to see that point, the time. So for some, February is 10,000. In the mileage log, you see the odometer reading is 15,000. That means that not match the record. So that means that the auto log is not real. Yeah, so that's very important for us. We need to keep the two repair receipt when it comes down to audit. So the thing I would like to recommend use some apps. Right now we can. I do see the My IQ. It's very helpful. So maybe you can use my IQ. Keep track all the My log. Yeah. So the other things like the meal. We must be ordinary and necessary for the meal side, and also we maintain the receipt. I want to get everybody have good habit is every time you get a receipt at the back, you write down who you had the meal for and what's their purpose, networking, marketing, perspective, or something, you write something in. So that one come down the audit and you know what's that for. Yeah, so the home office must be exclusive. And also I do recommend that we keep some photos. I mentioned that there's a home office. And also, as I mentioned that as they have less people, the chance they do go to see your home office is slim. Yeah, but we still need to keep track all the stuff in case we're lucky one. So the other things I would like to share with you, I mean, right now, as use the AI, they use all the historic data and to identify any outlier. So in just like rule of thumb, so I mean, expense exceed 30 to 40% of your income, then might draw attention to us to come to see you. Why? We have more expense, less income. Yeah, I think sometimes maybe that's true because we are the first year realtor. We had to drive a lot, and we had to spend more time, more expense. Like that makes sense. But you are the seasoned realtor, and it's not like we're making 100,000 income, and we have 90,000 expense. We're only making 10,000 on the net income side. So that maybe that's legit, but that maybe draw attention for them to see you why you spend more expense on that. And also, I would like to draw attention as a realtor, that's really challenge for us. We give out the business gift. And right now with the inflation, they still keep the same $25 per person. I mean, I know that it's unreasonable. $25, we cannot buy too much things. But I bring up those like the concern to the IS side, but they don't change right now, still $25. Yeah, that's really the challenge for us. Yeah. And also, we had a large deduction for coaching education and also marketing without very clear business connections. So that's things. How to avoid the business audit and ensure all the expenses are reasonable, and also keep the receipt and record for every deductions. So the other things for the large trouble contribution without the public documentations. Lately, I do see some of the return from the other taxpayer, and sometimes they make you happy, and they claim that I give you more refund. One thing I do see that they put a lot of large deduction on your Schedule A, but are you aware that when you sign the business tax return and you see the small wording under the penalty and perjury, you exempt the information, and that's true. You sign this bottom here. So that when come down the audit, it come down to your responsibility to back up all the donation stuff. So let's take a look at the donations. If any over $250, we had a written acknowledgement from the charity. And also non-cash donation over 5,000, we require the independent appraisal. And also we need to keep the bank statement, a donation receipt for the proof. Yeah, so, and that's one. The other things I would like to draw attention. Right now, they send out 1099K, NEC, and 1099K. So make sure our income is matched, at least not too much less than what they report. So that's one thing. So the other things, we give out the referral fee without issue 1099 if over 600. So that's come down to the questions when they come down the audit, because the other party don't report as the income on their side, and you try to deduct on your side, they disallow on that. Yeah, and also we have the cash transaction without any proper paper trail on that. Yeah. So the other things we might be qualified as a real estate professional. We can claim the real estate loss. So let me explain to you the real estate professional, the definition. So if regular people, they can deduct 25,000 on the loss side. If we are the real estate professional, we can deduct more on the loss from the real estate side. But you have to meet those criteria. First one, we have very active participation, so over 750 hours per year. And also 50% your income is come from real estate related activities. So for example, you're working full time and you're making 150,000. On the real estate, you're making 50,000. In that case, you don't qualify as a real estate professional on right off the expense side. Yeah. So and other things, I do see that sometimes we have the high commission speed. So we have the large referral fee paid without 1099, and also we have the high commission speed with no brokerage agreement. And that's some things when come to the audit they want to see, like we have a making commission, and we need to split the brokers, like the commission. You might need to prepare the brokers agreement to document those on those stuff. Yeah. So I know that I have a few more minutes, so that way I will answer the questions. Any question I can answer? Yes. That's a good question. I do see that sometimes it's on the audit reference side. So the question is, if we are the real estate professional, we write off the real estate loss, we write off the cost segregation, and we write all the expense against our ordinary income. So let me give you an example here. So we have 100,000 for real estate related income, 100,000. We have the rental property, and for the rental property, we do the cost segregation, and then we expedite the depreciation. So in that case, we lost about 50,000. So as the real estate professional, so we allow deduct the 50,000 against the 100,000 income. So that means that your income 100 minus 50 is 50,000. So yeah, it draw the attention for the audit. So in that case, I would like you to document. First one, you're a real estate professional, we have license. And the second thing is we document 750 hours per year is for real estate related, including selling the house, listing, or management the rental property. And we need to better document all those stuff. Yeah. So the question is, can we claim the rental income as the active income? It depends on what goal you would like to achieve. So let me explain to you the active income and the passive income. So active income, that's just like we are self-employed. That's our earned income. So we consider the real estate rental is our professional. So that's active income subject to self-employment tax. And let me explain to the passive income. Passive income, that's rental property. So rental property, so we had a rental over there. So every month we just correct the rent, and we maybe arrange for the repair. So that's the passive income. Passive income is not subject to the self-employment tax. So the active and passive, that's a different. But so the question maybe is for Airbnb. So you try to manage the like the Airbnb, and that's the earned income. Normally they put report on Schedule C. Yeah. So really the question for you, what's your goal? What would you like to achieve? So your goal examples, I put the active income, and your goals, you want to earn some like Social Security credit, or you want to be put away on the retirement side. Yeah, because I mean, as I mentioned, the question is if you don't have any earned income, and you might not be qualified for the IRA. So in that case, you might maybe consider that's the active income. Yeah, so it depends on your goal. Yeah, so normally people will use the passive income on that, but sometimes you would like to consider that's the earned income. I do see that some of my clients use that technique. Yeah, but you need to make an election for that.
Thank you so much, Jeff, for giving us such a wonderful information on taxes. I would like to invite you guys to come back for our next classes. April 9th, we have a class on global impact on LA real estate and economy with the upcoming 2028 Olympics. That's Wednesday, April 9th, 11 to 12. We also have on Tuesday, April 15th, 11 to 12, SB 721 balcony inspections. And on Wednesday, April 30th, we have Attorney Robert Brand, real estate risk management, staying out of court. Thank you for attending today. And on behalf of West San Gabriel Valley, we'd like to present a certificate of appreciation to Jeff. Thank you so much.
Thank you.